Bismillah, Assalamu alaikum. Welcome to another lesson. In today's class, we'll be able to distinguish between what free trade is and what protectionism is. We'll discuss some of the important trade barriers and some of the pros and cons of free trade and protectionism. And hopefully in this lesson we'll be able to actually complete this concept altogether. So since we've already covered what absolute and comparative advantage are, this is a relatively easy class for today. The first thing to obviously know is we've already discussed that countries will trade based on absolute and comparative advantage. However, based on the actual price data that has been given to us and based on the diagrams that have been drawn here, how do we determine when will a country trade, and how do we determine when will a country export a good, and how will we determine when a country import a good? So through these diagrams, basically, again, we will be comparing two different prices. We'll be comparing the price of a product in the domestic country with the price of the same product in the world economy. And we'll come up with two different scenarios. The first scenario will be, what if the domestic price is equal to the world price? Secondly, what if the domestic price is less than the world price? And number three, what if the domestic price is greater than the world price? What will happen then? So if the domestic price, the domestic price is determined where demand and supply of the product in the domestic market are equal. So this is the domestic price. Let's suppose if this domestic price is equal to the world price of the product. This means that there is no incentive and no benefit of trading. Neither will a country export the product nor will the country import the product. There is simply no benefit of trading because the world price is the same as the domestic price. The second scenario is if the world price is above the domestic price. So if the world price is above the domestic price, what will happen? In this case, the country will become the domestic country will become an exporter of the product. Why? Because the world price is obviously higher. That means this domestic country, will be actually selling its product to the domestic consumers at the same price compared to the world price. They'll be able to sell their product to the domestic consumers at this price, PW, because this is the world price. And at this price, they'll be able to sell their product to the domestic consumers equal to QD. However, at this price, they want to supply their product equal to QS. Right? So the surplus that has been left over, which has not been able to sell in the domestic market, that surplus will be exported to the foreign countries, to the world markets. So when the world price is greater than the domestic price, the domestic country becomes an exporter. And finally, what if the world price is less than the domestic price? In this case, the domestic firms will now be selling their product at this lower world price, and they'll obviously want to supply the product at QS, while the demand for this product at this price is QD. That means there's a shortage in the market. That shortage will be fulfilled or completed through imports. Right? Goods and services will be imported from abroad equal to the gap between QD and QS, or that shortage that is taking place. Right? This is something that is important for MCQs and for later diagrams, which we'll cover actually just now. One of the diagrams that is important for you to understand is the concept of tariffs. So let's actually go through what trade barriers are. The first and the most common type of trade barrier is tariffs. What are tariffs? Tariffs are indirect taxes imposed on the price of the product to increase the price of the product. Which product? Imports. So I'll repeat the definition. Tariffs are indirect taxes imposed on the price of imported goods to make them expensive and lower their demand. So tariffs are basically indirect taxes used to reduce the quantity of imports coming into the country. Now, how do we draw the diagram for tariffs? There are two types of diagrams that can be drawn when we're talking about tariffs. The first is the easier one, and I'm going to talk about that here. So, the first type of diagram that we can draw is the demand and supply diagram. Demand and supply. This is the equilibrium price, this is the equilibrium quantity. So, if the tariffs have been imposed, that means the cost of importing the product has increased. That means the cost of producing / cost of bringing the product into the local country has increased, which would mean that the supply of the product will fall. And as the supply of the product falls, the price rises and the quantity of the product falls in the market. This is one diagram that we can draw when we're asked to draw a diagram on tariffs and their impact on the economy. Another diagram that we can draw is actually this one. Let's suppose the domestic price of the product is PD, right, where demand and supply of the product are equal. And the world price of the product is PW, right? So when the world price is lower than the domestic price we just discussed, the country will import. So this will be the amount of import that the country buys from abroad. The difference between QD1 and QS1. Right? Now, the government believes that this amount of import is too much. So the government imposes a tariff on the price of this product, or I should say on the world price of this product, which means that the new price of this product in the world market is PW plus T, because this is the amount of tariff that has been imposed, which means that now imports have fallen to QD2 minus QS2, right? So this is the new amount of import that a country is undertaking of this particular product after tariff, which means imports have fallen considerably as a result of these tariffs. Right? This is the first type of trade barrier that a country can impose. The second type of trade barrier that a country can impose is known as quotas. Quotas are basically a physical limit imposed on the quantity / volume or value of imports. So, quotas can be a physical limit imposed on the volume or the value of imports. For example, a country is importing 100 cars a day, suppose, from abroad, right? The country's government then imposes a quota by saying that this country will not be importing more than 50 cars in a day, right? That means since the restriction has increased, obviously now the quota has fallen, in the sense that now you before you were able to import 100 cars, now you can only import 50 cars. So the quota has fallen, which means the restriction has increased, right? The trade barrier has increased, right? So this is basically what a quota is. So in this example that I just stated, the size of the import quota is falling. In the example that I've written here, initially the country could import 100 cars, now it can import 150 cars. In this case, the size of the quota is rising while the trade barrier is falling, because now you can import more cars than before. So the trade barrier is falling, the country is moving closer to free trade, right? So quotas are limits on either the volume or the value of imports that a country can buy. Number 3 is exchange controls. Exchange controls are limitations imposed on the amount of foreign currency that individuals can purchase in a day, in a month, or in a year, whatever. So for example, no Pakistani can buy more than $1,000 if that person doesn't have a visa or a passport. or a ticket to another country in a particular year. And if that person has a visa and a passport to travel to a particular country, I think then the limit is $10,000. A person cannot purchase more than 10,000 American dollars in that particular year, right? So this is basically exchange controls. Because you're able to impose controls on foreign currency, that means you're able to impose controls on imports as well. You're able to reduce imports because you need foreign currency to buy imported goods. Right. Then we have subsidies. Subsidies also are part of import quotas. Import restrictions or trade barriers. China is a country that uses subsidies as one of the most important sources of trade barriers. So subsidy, when the Chinese government gives subsidies to its producers or its firms, the cost of production of these Chinese firms falls considerably. And as a result, they are able to sell their product very cheap, not just to local consumers, but also to foreign consumers, right? And because the product, your local product, the Chinese local product has become so cheap, as a result, the Chinese government doesn't feel, or the Chinese public doesn't feel that they need the product from abroad, because they're getting a cheaper alternative from the local country, because the government is given a subsidy. So this is a trade barrier as well, because as a result of the subsidies, the product becomes really cheap. Hence, the demand for imports decreases, right? And obviously, you can make a diagram of subsidies as well. You can shift the supply curve to the right, which leads to a fall in the price. Then embargoes. Embargo is a complete ban on a product. Actually, not on a product. Embargo is a complete ban on the imports of a particular country. For example, like Pakistan has imposed a trade embargo on Israel because we don't recognize Israel, right? It can also be, by the way, an embargo can be on a particular type of a product as well, right? So obviously that leads to a rise in trade barriers as well. Then voluntary export restraints. Sometimes two countries reach an agreement where one country agrees to reduce its exports to another country. Why would that country do that? Number one, maybe because the domestic demand is not being able to, or the domestic demand is not being met because we are exporting our products so much. So that can be one factor. Another factor can be the other country is getting fed up of our exports. So we are basically afraid that they might impose really harsh restrictions on our exports, which may lead to a really sharp fall in our exports. So in order to appease that other country, we agree to impose our own restrictions on exporting our products to that particular country, so that we are able to still control the amount of exports that we are able to make to that particular country. Obviously, no doubt, those exports in terms of quantity will fall, but they won't fall as much as, let's suppose, if that other country is able to impose really severe restrictions on us, right? So these are voluntary export restraints. And then we have red tapes, economic and administrative burdens on exports/imports. So let's suppose the European Union has imposed really harsh conditions, quality standards on Pakistani products, right? So if we send our product and export our product to the European Union, a lot of the times they feel that our product isn't meeting their quality standards, so they send our product back to us. As a result, we're not able to get the revenue, and instead we're able to bear a lot of cost. So the next time we would think multiple times about exporting our product to the European Union, right? And that obviously leads to a fall in imports, because now the European Union won't be buying a lot of imports from Pakistan, right? So these are around 7 major trade barriers that are asked in paper 1 or paper 2. Another important thing to note is what is actually meant by protectionism. So we've discussed what trade barriers are. Trade barriers reduce trade, essentially. right? What is the concept of protectionism? Protectionism is actually policies through which the government tries to protect the local industry from foreign competition, right? When the government tries to protect the local firms or local industry from foreign competition by imposing trade barriers on that foreign product or on that foreign competition, that is the concept of protectionism. And obviously, protectionism goes hand in hand with trade barriers, right? Now, what is free trade? Free trade is when countries trade with each other without any barriers, and obviously countries specialize in those goods in which they're good at, and then they export those goods, earn revenue, and then from that revenue buy goods and services in which they're not good at, right? In which they don't have an absolute or a comparative advantage, right? So that is what free trade is. Now, there are a lot of benefits of free trade. So let's go through the benefits of free trade, and then we'll go through the benefits of protectionism. One of the biggest benefits of free trade is because free trade is as a result of international specialization. And international specialization means we're able to produce goods in which we're good at. That means we're able to produce a bigger quantity of goods and services if we are focusing on only those goods in which we're good at. That means the world output will increase, and at the same time the quality of the product will rise as well, because we're producing goods in which we're good, right? So, and that will obviously also increase employment opportunities too for the public. This is the first major advantage. The second advantage is there is a wider consumer choice for the general public, because we're able to get products of good quality from abroad, which we weren't able to produce in our local country. Number three, obviously economic growth and higher standards of living. This is an extension to point one. So I've written this here. Another advantage of free trade is free trade actually leads to better and cheaper technology, information, knowledge, and factors of production coming into the country. So we will be able to import better and cheaper technology, raw materials, factors of production, knowledge, and information from abroad, which will mean our cost push inflation will fall, right? Because our cost of production will fall, because we're able to get better raw materials and factors of production from abroad, right? This also increases competition, which means local firms get a greater incentive to produce better quality products because of higher imported competition. Then relations between countries also improve, obviously, because there is such a big interdependence and inter-reliance between countries due to this international trade. As a result, there is a greater an improvement in the relations between those two countries, right? So these are some of the advantages of of free trade. Now let's look at the arguments for protectionism. The first argument is to protect the infant industries, the sunrise industries. What are infant and sunrise industries? These are industries and firms that are newly starting. They've just started, so they're in their teething stages, right? Infancy stages. However, they have a lot of potential in the future to grow and become a big player in international markets and a big contributor to the country's GDP and employment in the future. But right now they need protection. Otherwise, imported competition will eat them alive, right? So to protect infant industries, trade barriers are important. Then to protect declining industries, sunset industries. Now, why do sunset industries need protection? Because sunset industries are normally big industries which are on a declining stage, no doubt, or are producing goods inefficiently. But at the same time, it's important to note that because they're big industries, they create a lot of employment opportunities, right? And imported competition will shut these declining firms down instantly, which will cause a massive rise in unemployment. Then another important point is to protect strategic industries which are important for the country, like Pakistan's strategic industries are agriculture, textile, weapons, obviously. So it's important to protect them through trade barriers. Number 4 is to prevent dumping. What is dumping? Dumping is when a country sells its products to another country, exports its products to another country at a price that is even below average cost. So they're basically selling their product at a price lower than average cost. Why are they able to do this? Why would a firm want to actually earn losses? This is actually done when the government is providing subsidies to those firms, right? So let's suppose the average cost of producing a product was $100, right? And the Chinese government has given basically a $25 subsidy on each product, right? So the private sector firms say that, okay, due to this subsidy, we'll be selling our product at $90, very low price, to Pakistan. So let's suppose these Chinese firms are saying we'll sell our product at $90 to Pakistan, right? Now, a lot of students say, sir, but this firm is making a loss of $10. Actually, it isn't. It is making a profit of $15. Why? Because this subsidy actually cuts down the cost for the firm. Yes, it is creating a burden on the government, but the government can handle it, right? So this subsidy is actually cutting down the cost, so this firm is actually still able to get a profit. But the other countries' firms where this product has been dumped, Pakistan, for example, Pakistan's firms will suffer massively. Why? Because Pakistani consumers will be better off because they're able to get a very cheaper product. But Pakistani industries will suffer massively because they are not able to compete with this price. And as a result, those industries will shut down, there will be an increase in unemployment, etc. Right? Then, another big reason why trade barriers are imposed is to improve the balance of payment. So, in order to improve the balance of payment of the country or to improve the current account of the country, the government wants to obviously reduce imports. They do that through trade barriers, right? Another important point is to raise government revenue. The government imposes tariffs on especially inelastic imports. That leads to a high revenue. And finally, to discourage and reduce the consumption of demerit goods, a country is able to impose trade barriers on those on the import of those demerit goods, right? So these are some of the pros of free trade and protectionism. At the end, what can be a summary? Let's suppose the question comes, okay, whether free trade is better or trade barriers are better, right? It actually depends on where the economic situation of the country is. So if an economy is developed and if the economy has a healthy balance of payment and its own firms are able to produce good quality, cheaper products, then free trade is actually very good. Because in that case, the government and the economy isn't in the fear of getting into a deficit and for local firms to actually go out of business, etc. Right? But if developing countries which are struggling, if they're concerned, trade barriers for them are better. Yes, they won't be able. And by the way, trade barriers, selected forms of protectionism. So they shouldn't impose trade barriers on all goods. But selected trade barriers would be important in order to protect their balance of payment and their local industry. Right? So this is basically the entirety of this chapter. The next part of this is actually economic integration or trade blocks. This is something that has actually been now moved to the A2 curriculum. So I won't go through this right now. We're done with this chapter on international trade. The next chapter that we'll start will be on exchange rates. It's a relatively lengthier chapter, even though exchange rate has been divided into the AS and A2 curriculum. Floating exchange rate is in the AS curriculum, and fixed exchange rate is in the A2 curriculum. I will be going through the entire concept in that particular, in those 2 to 3 lectures, right? So I'll be going through the exchange rate in its entirety, both AS and A2 curriculum in one go, right? So inshallah, in the next lesson, we'll be able to start that. Till then, Assalamu alaikum.